Hi, welcome to this video on net present value and internal rate of return. Now what I wanted to do with you today in this video is to go over an example. And by the way, this example that I'm going over is pretty much the homework. So the idea in this video is I want to show you how do you take a capital investment decision. And that's the use of what we call net present value and internal rate of return. And that is an application you've learned about in using time value of money. So what I want to do is put all that together. So in my investment decision today, what I have is an olive orchard. We're looking at planting 25 acres of an olive orchard, trying to diversify our farm or ranch operation. I know of a family that has done this down outside of Houston area. And so anyway, olives are grown in Texas as a demanded product, and it's a Texas branded product. And so a lot of people are looking at what would this be like. So I got some information pulled out from University of California, Davis. Not a lot in Texas yet, a little bit on extension, but we want to put this information to the test. And we want to run what it would look like possibly if we decided to put in an orchard of 25 acres. Now it's going to cost quite a bit of money up front. We're going to have to buy the trees. We're going to have to get the land. We're going to have to prep the land. We're going to have to get all this put together. So there's a cost up front. And the question is are the returns that come in the future worth it? Is it worth the money up front? That's called a capital purchase decision. And that's what the focus of our homework is and the focus of this video. So let's take a look at how you would get this done. And once again, this does help you with the homework. Let's take a look. All right, whenever you move into your homework and open the file, you're going to be given some information here. Let's read through that. The following is information about a potential business to plant olive trees and develop an orchard. It's 25 acres. The question is, we know a little bit about what it's going to cost up front, and we know a little bit about the timeline, which I'm looking at is 20 years. We could keep going out further with an orchard, but we'll stop there and make our analysis decision. And we need to find the variables. So what I've done is I've pulled some UC Davis data and developed some annual income and then looked at how that might work for us in the very beginning. Not selling much at all, finally moving to where we can sell. In year 7, I want to factor in the purchase of a mill. So we'll actually start milling our own olives and we'll start bottling our own. So I've got additional costs factored in there, but it's a whole lot more lucrative if you sell the oil versus just selling table olives. So we're going to start out in years, needing years, and that's going to be time. So in your table, I have developed for you the time we already have. 0 meaning today, all the way through year 20. Capital investment, I've created a column for it, but I have not inputted those values. You will have to do that in the homework, and we'll go over that. Annual operational flow, I've already tried to calculate out into the future, and it looks like in the very beginning we're going to lose operation cost right away in year 1. We're not going to harvest anything. In year 2, we'll start to harvest a few table olives, and so you can see we lose a little less money. Finally, it looks like in year 5, we actually turn a profit. Then in year 6, we get a little better. And then in year 7 is when we add in our own mill and start milling our own olives. And then we keep going up through here and finally getting to the end. Net cash flow is going to be the summary of whatever we had to pay up front, adjusted by this annual flow. So let's start off in our first step. And before I do that, here's the questions to address. What is NPV IRR? Is it a good decision or not? And then we're going to change some things like it costs 10% more to get started in this initial investment, or leaving that cost higher. What if our opportunity cost was 8%? Right now, our opportunity cost is 5%, meaning that we're going to need 5% return on our money to make this a good decision. All right, that's going to be based on things we talked about before about risk-free rate, and time. All right, so let's get started. Capital investments, when do we pay out? Well, right away, I'm going to put a equal sign and a negative value because we've got to pay up front $340,000. I'm going to jump down to year 7, equals negative. We got to pay $75,000 in year 7. All right, so that gets in where our investments are. I've given you the annual money. So let's go over here and do net cash flow. Just equals, and whatever we paid up front plus whatever money we might make that year. that's going to be a negative 340. I've already written the formula, so I just copy and paste it down to the bottom, and it fills out the rest of these. So for example, in year 1, we don't have any capital investment, but we lose $50,000, so that's our net. And you can see we finally do start making money in year 5. We don't really have any outflow of capital, so we get a little money back. Year 6 next year, we get a little better. In year 7, we had to pay $75,000 up front. We still were harvesting, but that ends up making us short $15,000. And then finally, in these next years, year 8 all the way through 20, we are looking like a positive cash flow business, but it took us a while to get there. So that's kind of the question. All right, so we've got our annual net cash flow figured out. You've got to do that. Next is net present value. How do you do that? Well, once again, press the f of x function here. That brings up our formula area. Several ways to do this, but NPV is the formula. Double click it, it opens up and asks us the question. So for example, rate, my cursor's right here. I move over to the rate and choose 5%. Values, now this is very important to get right. On the values, you have to start with value 1. So I'm going to start with the 1 year right there and slide down. Those are all of my values, okay? Now, in my formula down here, I'm going to hit plus. So I've got NPV, the rate and the time, but I need to add back that beginning value, that $340,000. If I hit enter there, it comes up with a positive $275,000 return. So that looks like a good deal for us. That seems like that's a good number. Let's keep going. What about internal rate of return? Once again, press the f of x, get the formula, go over here, IRR, hit enter. Tells us there's the formula. It's just looking for values. So you just have your cursor right there. And this time you can start at year 0. And you can go all the way to the end and hit enter. And it looks like we're earning 9% back on our money. All right, so there is the analysis I have so far. What are the questions? Well, NPV. So I just choose copy. Go back there and choose paste special and just say I want the value. In other words, I don't want the formula. I just want the answer. And the answer is going to be $275,000 net present value. IRR, same idea. Right click copy, go to that cell, paste special, choose value, hit enter. That's a percentage. So I can even move the decimals out if I want. That's 8.87% return. So does the investment meet our payback needed? Do we bring the money in? They have yes there because we have a positive net present value, okay? All right, now what's the actual rate of return? Well, we wanted to earn 5%, but it looks like we're earning 8.87%, so I enter that value there. All right, so far that's what we know. Now, here's where things get interesting. What if things change on us? I've already got this all set. Your variables are set. The calculations are already being done. But what if our investment was 10% higher? Well, this is really where our investment is. However, this is where we used it. So if I look at this, I could just take that number and do a 1.1 times that. That ups it by 10%. So that didn't work, actually. I guess I need to put a times in there. And so that means that's $374,000. So it was $340, now it's $374,000. That flowed over to our value there. The net present values are the same calculations. The rate is the same calculation. And so really, the answer is that our net present value is now going to be, let's look and see, paste special, turn that to a dollar symbol. It's a little bit less. Instead of 275, it's 241. What about our IRR? Copy, paste, special. If you do paste, it will try to move the formula over there and it'll just give you a bad answer. So you got to do paste special. I'm going to expand those decimals out. Yes, we earn a little bit less, but what's our decision? Still a good investment. Based on our values, it's still a good investment. And the reason why I should add to that, because NPV is positive and IRR is higher than we required. All right, so it's still a good investment. All right, what about if we keep going here? All right, we've looked at the risk of this. We've decided that, all right, this initial cost may be it, but we're really concerned about all of these incomes. I mean, this is way out there in the future. We've got a lot of uncertainty. Weather can kill olives. In other words, getting too cold too fast or not getting cold enough. Too little water, irrigation costs go up for us. We're not really sure. So we come in here and say, you know what, this is really riskier. So remember, the opportunity cost of the rate is time and risk, and then risk-free rate. So our risk is higher than we think. We're going to change this to 8%. So once again, I just hit 8%, hit enter. And now we start to look at what it would be worth, and our answers changed. I'm going to copy this. I'm going to paste it there. And values, it's $14,000. IRR, I'm going to copy it and paste it in there as a value again. Also change that to a percentage and give me a little more decimals. So what's your decision? Well, the answer is it's still a good investment. Why is it still a good investment? Because NPV is positive. IRR is greater than our needed rate, which in this case was 8%. It's 8.24%. All right, so this is net present value. The idea is we are needing to somehow get the net cash flow for our operation out 20 years. If you extended this from 20 to, let's say, 40 years, because these olive trees will just keep producing, then you may be looking at a little bit different values here. However, our 20-year time frame is really our planning horizon, so that's what we set. By the way, these values become less and less worth money today, because if you get it further than 20 years, it's hard for them to really be very valuable today. So really their impact becomes smaller and smaller. You can keep adding to it. You won't change these answers a whole lot. But our 20-year planning horizon tells us that we've got a positive net present value, and actually that never gets negative in our situation. Now, it's not in the questions, but what if we just kept saying, man, this is really risky. I'm going to look at this current situation. Do you see the value of 8.24 here for our IRR? I'm going to change this to 8.24 and watch what happens. It's going to almost be zero. In fact, that's really not 8.24. Let me keep going, pushing all that out. That's what that number is. So let me just copy that value and paste it right there. That means that when you have IRR, it is telling you what this investment is earning. Now, IRR is telling you what it's earning. So if you said, well, that same amount of earnings is my risk rate, then net present value would be zero. So if your risk rate is greater than this, let's say it's 9%, now we're negative. It won't earn that. In fact, IRR is telling you it is earning 8.24%. So if you want to earn less than that, the answer will be good. If you want to earn more than that, then your answer is going to start to become negative, like it is in this case at 9% or 10%. We're not earning it anymore. We're earning 8.24%. So if you require it to earn more, then that's not going to work. All right, so going back to where we were at 8%, it looks like that it is still a good decision because it is positive, and that is what we're trying to figure out in our calculations. So NPV positive, good decision. IRR is going to be greater than what we required. Again, good decision. Hopefully this video helps you see how you can calculate this. Now, in your homework, make sure that you take the file I've loaded and finish out these sections so that you can calculate these values and do what-if analysis. Thanks.